Welcome, curious minds, to another deep dive. Today, we're really cutting through the noise. We want to bring you the most impactful insights from John L. Person's A Complete Guide to Technical Trading Tactics. Our mission, well, is to give you a shortcut, really. A shortcut to truly mastering the mechanics and, maybe more importantly, the mindset that elevates professional traders. We're aiming to go beyond just generic advice here. We've really dug into this guide, and what we'll discover isn't some get-rich-quick scheme. Not at all. It's about understanding the specific tools and, crucially, the mental game. That's what can genuinely elevate your market knowledge, especially if you're already, somewhat familiar with the trading landscape.
That's absolutely right. Person's core message, it isn't just here's another indicator. It's really about the integration.
Integration.
Yeah, integrating that mathematical precision, things like pivot points, with the more traditional technical analysis. It's about using these different lenses, if you will, to confirm, to validate, and really pinpoint your entry and exit points. And applying them across different timeframes too, daily, weekly, even monthly. The real power, he argues, comes from enhancing what you already know, not just throwing it out and starting over.
Okay, so our journey today, it's about unlocking secrets, right? Seeing patterns with new clarity, understanding those powerful underlying forces, and maybe most importantly, mastering that inner game of trading. So why should you care? Well, because as you'll soon realize, the biggest hurdles to trading success, they often aren't out there in the market. Surprisingly, they might be a lot closer to home. Okay, let's dive straight in then. For an informed audience like ours, what does John Person really mean when he talks about technical trading? How does he set it apart from, say, long-term investing? He uses that Goethe quote, doesn't he? Thinking is easy, acting is difficult.
And to put one's thoughts into action is the most difficult thing in the world.
Yeah, that quote is spot on, because it immediately flags the action-oriented nature of trading. Person defines trading not as, buying and holding assets for the long haul. It's about actively turning over capital. You're capitalizing on price changes.
Buying and selling.
Or even selling first and then buying back.
Mm-hmm.
The goal is purely to build cash. Futures trading is a perfect example, right? You're not looking to actually own thousands of bushels of corn.
Right. You just want the profit from the price move.
Exactly. That's fundamentally different from long-term investing, where you buy, you hold, and you're hoping for appreciation over years, maybe decades. And, Person's own background really shaped his perspective here. It's quite fascinating. He started as a runner on the floor of the Chicago Mercantile Exchange way back in 1979.
Wow, 1979, down near 900. Different world.
Completely different. And he learned directly from some of the masters, people like George C. Lane.
Lane, the guy behind stochastics. That's the one. The oscillator, stochastics, still a hugely popular momentum indicator today. And he even knew people who were direct students of Charles Drummond.
Drummond geometry. That's pretty specialized stuff.
So it's specialized. A unique way of forecasting price based on geometric patterns. So this direct lineage, learning from the greats, it gives his insights a real depth, a practical edge you don't always find.
That's an incredible foundation. Now, he makes this pretty bold statement. He says the biggest obstacle in trading is what is between your left and right ears. That clearly points to psychology, but the biggest obstacle. Why does he stress that so much?
Well, he doesn't just say it's important, he puts a figure on it. He firmly believes about 80% of successful trading comes down to your emotional makeup.
80%, that's huge.
It is. And think about it, emotions like fear, doubt, complacency, greed, even just excitement. They're not just, background noise. They can actively sabotage the best laid plans. You might know analytically what you should do.
But your fear stops you, or greed makes you hold too long.
Exactly. Your emotions prevent you from doing it, or they push you into doing the exact wrong thing at the wrong time. So this deep dive, really following Person's thinking, aims to give you the practical knowledge, the frameworks, to build robust trading plans. And those plans, in turn, help you conquer that jungle of emotion, as he calls it. It's about building a confident, winning attitude, equipping your mind just as much as your analytical toolkit.
All right, understood. The mindset is paramount. Now let's pivot. Let's look at the practical tools, the lenses Person teaches us to use to actually analyze market data and spot those opportunities. What are the core analytical tools he really emphasizes?
Okay, so we'll focus on how technical analysis takes all that messy market data and distills into something actionable, primarily through charts and specific indicators. Now, everyone knows basic bar charts open, high, low, close, simple enough. But Person also highlights point and figure charts. These are quite different.
How so?
Their unique power is that they completely strip away time. Time becomes irrelevant. Only price movement gets recorded. You see X's for upward moves, O's for downward moves.
Interesting. So what's the advantage of ignoring time?
Well, the key insight is how they help traders cut through all the time-based noise, the minor fluctuations within a day or a week. They let you see pure trend momentum, revealing market conviction or weakness in a way other charts just can't. He does note, though, that they require some careful tweaking to optimize them for specific markets or timeframes.
Okay, point and figure for pure price action. But thinking about patterns, the book really seems to lean into Japanese candlestick charts. I found those names fascinating. Hammer, shooting star. For someone looking for an edge, what makes these visual tools so potent? How do they help you read the market?
Yeah, the candlesticks. Their power lies in their rich visual storytelling. It's quite immediate. Each candle gives you a concise picture, open, high, low, close for that period. You've got the real body and the shadows or wicks. But the real magic, like you said, happens when individual candles combine to form distinct patterns. Patterns that signal potential reversals or maybe continuations. Take a hammer, for instance. Small body, up near the top of the range, long lower shadow.
Okay.
It typically appears after a downtrend, and its message is pretty clear. Sellers tried hard to push prices down.
But buyers stepped in.
Aggressively,
Yeah.
exactly. Signaling a potential bottom might be forming. Conversely, you have the shooting star. Small body, down near the lower end of its range, long upper shadow. This one shows up after an uptrend. It tells you buyers tried to push higher, but strong selling pressure emerged, indicating a potential top.
So they're like little visual alerts about sentiment shifts.
Precisely. They're quick, intuitive visual cues. Much faster to process than just looking at numbers sometimes. And another really crucial one is the doji.
The doji, that's when the open and close are almost the same.
Exactly. Very small, real body, sometimes just a line. What it screams is indecision, uncertainty. The book mentions variations, gravestone, dragonfly, rickshaw doji, each with slightly different nuances depending on the shadows. But the core takeaway for us, any doji signals a critical moment of equilibrium, a pause, a potential turning point. If you see one pop up at a market top after a strong rally, that's a powerful warning. Momentum might be stalling out.
Those visual patterns are incredibly powerful, huh,
Yeah.
for spotting shifts quickly. But for traders who also want that precision, concrete numbers to back up the visuals, the book moves us towards something more purely mathematical then, doesn't it?
It does. And this is where pivot point analysis comes in. He presents it as a really powerful weapon. It's widely used by professional day traders, floor traders, because it gives them concrete, mathematically derived price levels to watch.
Mm-hmm.
And the interesting thing is, the market often seems to respect these levels.
And the calculation is simple.
Deceptively simple, yeah. You just take the high, the low, and the close from the previous session, say, yesterday's trading. Add them together, divide by 3. That gives you your core pivot point, or P.
Okay.
And from that P, you mathematically derive clear resistance levels above it, R1, R2, and support levels below it, S1, S2.
So these aren't just static lines on a chart. How do skilled traders like Person actually use these levels, in the heat of the moment? What does it mean in practice?
Right, they're incredibly dynamic. They act like potential battlegrounds for the upcoming session.
Yeah.
They indicate potential price ranges where the market might stall or find support, and they also identify potential breakout points. Person explains he uses them across multiple time frames, daily, weekly, and monthly. Each gives a different perspective.
Oh, okay, multiple layers.
Exactly. And he gives this really compelling example from the sugar futures market. The monthly pivot support level was calculated at 6.09. The actual market low came in at 6.01, almost perfect alignment. But here's the key insight, the way he teaches it.
Mm-hmm.
He didn't just blindly buy based on that pivot level alone. He combined it with a visual pattern, something called a 3-gap formation. And it was the combination of the mathematical pivot point and the visual chart pattern that gave him a strong, high-probability buy signal.
Ah, so it's about confluence, multiple signals pointing the same way.
Exactly. That's his big emphasis, combining techniques for robust verification, giving you multiple layers of confirmation before you commit capital.
Okay, that makes a lot of sense. So charts give us the visual story. Pivot points mark those key mathematical levels. We're building a solid framework for analysis, but, no trader works in a bubble. Beyond our own charts and numbers, what about the broader market, the other players, the collective psychology? What other currents do we absolutely need to tune into to get the full picture?
Absolutely critical point. We need to look at that broader market behavior. Participation levels, yes, but also that collective psychology. We all know about volume, the number of trades, and open interest, and a total number of open contracts, basic stuff.
Right.
But person highlights their real power when you combine them with price action, looking for divergences or confirmations. For example, rising volume with rising prices. Classic bullish confirmation suggests new money is eagerly coming in.
Standard interpretation.
But here's person's deeper insight. He talks about climaxing market conditions. This is where you see wide daily price swings, unusually strong volume, but open interest starts to decline.
A decline. That sounds counterintuitive.
It does, but paradoxically, it can signal a major trend reversal is imminent. Why? Because it suggests the market is exhausting itself. The last buyers at a top or sellers at a bottom are getting in, but existing positions are being closed out faster. It's like the fuel's running out.
This is a read on collective exhaustion almost.
Exactly. A crucial read on collective psychology, signaling the trend might be about to roll over.
Okay, that connects to understanding the herd. It sounds like knowing what the crowd is doing is vital, and maybe even more vital to think differently sometimes. Is that where contrary opinion comes in?
Precisely. That's the heart of contrary opinion analysis. And a key tool here is the Commitments of Traders report, the COT report.
Right. Released weekly by the CFTC.
That's the Commodity Futures Trading Commission, yeah, the main regulator for futures. This report breaks down positions by trader type. Commercials, these are often the hedgers, usually considered the smart money, because they're closest to the underlying physical commodity.
Okay.
Then you have large speculators, hedge funds, big professional traders. And finally, small speculators, the individual retail crowd, like you and me.
And the insight is?
Watch for extremes.
Yeah.
If you see the small speculators holding a historically massive number of long positions, super bullish, while at the same time the commercials are heavily net short, that can be a major warning sign.
A signal that a top might be near.
Exactly, because if the dumb money is all in bullish, who's left to buy and push prices higher? The crowd is very often wrong at major turning points.
Makes sense. Look for those extremes.
Another really potent sentiment indicator is the VIX, the volatility index.
Ah, yes, the fear factor gauge.
That's the one. And historically, the relationship is often inverse. A low VIX reading, say, below 20 signals widespread complacency, nobody's worried.
Which happens at market highs.
Frequently. So a very low VIX can actually be a sell signal. It means the market might be vulnerable, too complacent. Conversely, an extremely high VIX reading signaling peak fear, panic selling. Think levels like 45 or 56, like we saw during the market lows back in 2002.
That could be a buy signal.
A powerful buy signal, potentially. It suggests the downturn might be nearly over because all the fear, all the selling pressure has likely been wrung out of the market. Person's advice here is succinct and memorable. Don't get bearish in the hole.
Meaning don't panic sell right at the bottom when fear is highest.
Precisely. You don't want to be selling when everyone else is panicking. That's often the point of maximum opportunity for buyers.
Okay, so we have all these sophisticated analytical tools, the charts, the pivots, the sentiment indicators.
Yeah.
Yet the author keeps hammering home that 80% of trading success is about what's between your left and right ears. That's such a huge claim. But, I think anyone who's ever tried to stick to a diet or a workout plan, they get it. Knowing what to do versus actually doing it are two different things. So how does he argue we actually conquer that emotional jungle? How do we become consistently successful, even if we have a great analytical system?
Yeah, it really boils down to self-awareness, rigorous discipline, and having a meticulously crafted plan. Person really hammers home that old adage, those who fail to plan to fail. And this isn't just, having a vague idea of what you want to do. It means defining your exact entry point, your profit target exit, and critically, your stop loss exit, your risk parameter before you even think about clicking the buy or sell button.
So you make the rational decision before the emotions kick in.
Exactly. That pre-commitment is key. It takes the guesswork and the emotion out of the heat of the moment. You've already decided what to do under various scenarios. And absolutely crucial to making that plan work is realistic expectations and capital management. Person really urges you to be brutally honest about your capital size. If you've got, say, $10,000 in your account, trying to trade a contract that requires $20,000 margin, well, that's just asking for trouble, isn't it?
Setting yourself up for failure.
Right. His practical advice is sensible. Maybe use only 50% of your investment capital in any single trade idea, and on your very first trade within that idea, risk only maybe 20% of that initial capital slice. This kind of disciplined position sizing directly combats that paralyzing fear of taking a big loss, and it also limits the damage greed can do because you're not betting the farm on one trade.
Keeps you in the game longer.
Definitely. And this leads naturally into the ongoing battle of managing emotions. Fear, doubt, greed. They're not abstract. They are tangible adversaries in trading. Take greed, for instance. It's that siren song, right? It causes you to watch perfectly good profits evaporate because you're holding out for that elusive grand slam.
Instead of just taking the solid single or double.
Exactly. He suggests sometimes a series of base hits, consistent smaller wins, is far more sustainable and ultimately more profitable than always swinging for the fences.
That makes sense. Consistency over home runs.
Person also emphasizes the power of a break. This is important. If you find yourself getting frustrated, you're on a losing streak, or even if you just feel that lack of desire, that burnout, his advice, stop trading immediately.
Just step away.
Step away. Take a break. It could be a few weeks, maybe even a month. It can be incredibly restorative, gives you fresh perspective, allows you to clear your head, refocus your game plan. It's like an athlete resting an injury, right? You need recovery time to get back to peak performance. This isn't quitting, it's strategic recovery.
Okay, that's a really practical tip.
And interestingly, he also touches on affirmations and visualization. Now, he acknowledges up front these might sound silly or absurd to some analytically minded traders.
Yeah, a bit woo-woo, maybe.
Perhaps. But he includes them because they are proven methods for mental conditioning used by top performers in many fields. Consistently telling yourself, I'm a successful trader, or visualizing the entire process of a winning trade from entry to exit, it can powerfully reaffirm your subconscious mind, help combat those destructive negative thought patterns.
So actively shaping your mental state.
Proactively shaping your mental landscape for success, just like athletes visualize winning before the game even starts. And finally, the book shares some really profound wisdom from other experts he's interviewed or knows, which really underlines this whole inner game theme. Mark Douglas, the author of The Disciplined Trader, he famously says every single trade outcome is essentially random.
Random. That sounds bleak.
Well, his point is the market does what it does. The problem isn't the market's randomness. The problem is usually the trader's reaction to that randomness, the lack of discipline. And John Bollinger, the creator of Bollinger Bands, a very popular tool,
Right.
he apparently once advised listeners on Person's radio show to take a course in human behavioral psychology at their local community college if they really wanted to understand trading better.
Wow. Psychology 101 for traders.
Exactly. These aren't just clever anecdotes. They profoundly reinforce the idea that mastering yourself, your own mind, your own emotions, that is the ultimate trading edge.
Okay, this has been a really comprehensive deep dive. We've unpacked so many layers of technical trading, from those intricate patterns on a chart all the way to the profound and often challenging patterns within ourselves. As we wrap up, what's one final, maybe provocative thought you want to leave our listener with? Something to really mull over as they consider their own trading journey, building on all these insights.
Well, Person closes with, or uses, a great quote from the legendary coach Vince Lombardi. Lombardi said, "Success is measured not so much by the wealth or position you have gained, but rather by the obstacles you have overcome to succeed." And that applies so perfectly to trading, doesn't it? There's no single magic bullet trading plan that's going to guarantee riches. It just doesn't exist. But the real goal, the achievable goal, is to continuously learn, adapt, and refine your methods so that over time, your profits consistently outweigh your losses. It's about continuous learning, being meticulously prepared, and relentlessly cultivating that confident, disciplined mindset. And you know what? It's absolutely okay to be wrong sometimes. Every single trader is wrong frequently. But the true mark of mastery isn't never being wrong. It's learning from those mistakes and absolutely refusing to make the same errors over and over again. That's the real journey.
A truly powerful thought to reflect on. Overcoming obstacles, not just seeking perfection. Whether you're a seasoned trader out there looking to sharpen your edge, or perhaps just beginning to explore this nuanced world of markets, the principles Person lays out, combining that meticulous analysis, disciplined risk management, and crucially, a deep understanding of your own psychology, they really are invaluable. Thanks for diving deep with us today.